A new year, a new decade, and new resolutions. I'm sure you've made all the resolutions that you need to for 2020 and beyond. But what about investment? Have you made investment resolutions for 2020? This is the topic that we will discuss in today's program, brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. With me, it's my pleasure to have Dhirendra Kumar, CEO of Value Research. Dhirendra, welcome.
Thank you.
Before I venture into the new 2020 question, just take you back into flashback about 2019 as to how was that year for mutual fund investors?
It was a mix. Purely based on performance, it was not an outstanding year. It was not even a disappointing year. It was an average year, despite all the turbulence. Equities did okay. They did not do very well. Fixed income was quite a teaching. Investors learned that, all that is being said that mutual funds are subject to market risk. Mm-hmm. They actually got, they experienced, the risk. And the fallout of all this was that, mutual funds, regulators got into act. The bad part is that, it was a lackluster year on performance front and the economic slowdown and all that thing translated into nothing meaningful. But the good part was that, mutual funds became less expensive. Okay. They became cheaper. They became purer with the classification system getting implemented. So what you see is what you get. A small cap fund will remain a small cap fund. A mid cap fund will be a mid cap fund. So on and so forth. Even in fixed income categories, there are different problems. The problem of plenty. But what is being said is what it will be. So it became clearer, purer, cheaper, and also it became safer because as a result of all this fixed income crisis that we have seen, there are two sides to the story. One is that you have this fixed income fund which faced the first ever crisis where they witnessed a decline in value. Companies' bond which these funds bought, some of them were unable to honor the commitment, the promise of timely repayment of principal or the interest. Okay. They were facing default, and that led to creation of this segregated portfolio, what is generally called side pocketing. That's a good thing. That's a nice regulatory move, which actually ensures that any money which will be recovered in future will get back to the investor, his entitled money. And so broadly, I would say that it was a year which actually gave investors a lesson, and regulators tightened the whole framework of mutual funds.
Equities, they also had a roller coaster ride in 2019.
Mm-hmm. Equities are like that only. Okay. That's the nature. But despite that, the narrowness of the market, the fact is that equity market, whatever we may say, is primarily driven by companies making more money than they made in the past, or the likelihood of they making more money in future. Okay. And that thing was, this particular expectation was not generally perceived in the market. Of course, companies are not making money; they are not growing more faster, and the earnings primarily. And it's very normal. It's every the markets are cyclical. So are the economic cycle.
Okay.
I think this cycle can linger for longer, simply because the operating system of the nation, the business framework, the economic framework, the operating system is changing. A lot of things have changed, and I think they have changed in an irreversible way. So the result of all those economic policy is that businesses will face some problem, and it might take longer for earnings momentum or earnings growth to come back, but it surely will come, because the whole India story remains intact. There are young people, there are a lot of the consumption story. Of course, one has to see that that the narrowness of the market, that leads to a lot of investors asking the question that they were betting on the small cap, mid cap, multi cap, and the large caps have started running once again, and not the whole market. So that remains a problem. But I would say that the same thing which we keep repeating all the time, I think it's a reminder that, don't get distracted from the core principles of your personal finance that you follow.
So what about should one stick to the large cap fund? Should one get into multi-cap funds, and vis-a-vis the performances of these two? Would you like to elaborate on that?
Yeah, I would say that, simplicity, or the pursuit of simplicity, should not be compromised. Because, the fact that large caps did well, large caps gave 11% return. But the fact is that, when we say that buy the multi-cap fund, they gave 9.5% or, close to 10%. So it's little less than the large caps. But the fact is that when you buy a multi-cap fund, they are generally investing 60-70% into large cap. You are not deprived of that. Yeah. Selectivity works there. And so I would say that because there has been years when large caps don't do well. And when you choose a large cap, then the fund manager lacks the flexibility to go elsewhere. So for an investor, if you are actually looking at a low maintenance portfolio, an investment which you make, and after that you don't have to intervene to anticipate which part of the market will do better. That is why you should have multi-cap. So I think the case for multi-cap for simplicity, a low maintenance, and trying to, guess the market, because markets are unpredictable. Even when markets do well, which part of the market will do well is very hard to guess. So don't try to, over-engineer things. Keep it simple. Stick to your plan. And I don't think it's a huge opportunity loss. And you will get some years when all those losses get recovered. Look at this, large caps are up 11%. And multi-cap is up 9.5%. But look at 2017, when large cap went up by 30% and the average multi-cap went up by 37%. So that's 7% extra return. And consistently superior return. 2018 was a washout year for multi-caps when they were down 5%, while large caps were able to hold the ground. But net, I would say that, you will not be deprived of, if you are investing for the long run, if you are investing for 5 years and more, if you are a regular investor, I think multi-caps is still the best way to, to invest.
Okay. So in the current scenario, what are the mantras for investment plan vis-a-vis what has happened in 2019? As an investor, what is it that you would recommend to the investors? Okay, keep in mind these 6 things, 4 things, 5 things, or many more things.
Yeah, no, I would say that, you have the same old stuff. If we were talking about this in 2001, I would have said the same thing, or 2011, I would have said the same thing.
And now the same, right?
Yeah, because these basic principles are non-negotiable. Yeah. These are the only things which an investor has. If nothing else is in your control, you have to remember that, if we were doing this program and, if we were doing this chat in 2001, the market was at, 2,800 points or less than that. And 2,800 points on Sensex, and next decade you get, it goes up by 10 times. And then subsequent decade, it still generates a 13-14% return.
Right.
This time period itself takes care of, most of the problem or most of the anxiety which an investor would have encountered or faced in all these years were not very easy. You had 2008 in that decade. You had all the kind of economic crisis.
The roller coaster ride.
Despite that, you were able to generate these returns. Beating inflation, beating fixed income return is what a investor should aspire for. So I think, stick to the basics. Okay. Don't try to guess the market.
Don't try into the one by one.
I would like to get into, list them, that invest your long-term money in equity. Don't try to guess the market. Stop the waiting game. Don't think that, now the market has corrected. It will correct a little more. Then I will start investing. So don't time it. Which means be a regular investor. And investing your long-term money, the money which you are not unlikely to need for next 4 or 5 years, only that money you should invest. Otherwise, you will get anxious about your investment. Diversify. To put it simply, invest in multi-caps, you get diversification. Or you invest in a balanced fund, you get greater diversification with even more stability, because it includes fixed income as well. That's about it. And once you have done this, do the reverse as and when you need the money. So you invest regularly, you start disinvesting regularly as you get closer to your goal. You keep investing for 10 years, and you need the money after 10 years. Maybe start withdrawing a part of the money which you need after 10 years, a year before, so that you are not dependent on the market. So invest regularly. Asset allocation, you have to stick to it. If you are investing in, asset allocation, there are two ways of looking at asset allocation. One is that, when we are investing, when I'm asking to invest you in a balanced fund, if you're not an experienced investor, asset allocation is taken care of in a sense that your 70% of your money will be in equity, 30% in fixed income, and the fund manager himself will take care of it. That it remains like that.
Right. And we've been talking about
We have been talking about it. If you are doing it yourself, if you are investing in equity funds yourself, debt fund yourself, and equity does very well, and the allocation which you have decided has gone out of whack, rebalance periodically, and that periodically should be maybe an annual review, that what is your equity allocation now and fixed income allocation now, and change accordingly. If equity has gone down in value, move your money from fixed income to equity to rebalance it to 50-50 or whatever.
Can an investor do that on his own, or does he need
an investor can actually do it. And in fact, if you set up your portfolio, the account statement which you get from CAMS or Carvi, if you upload it on Value Research Online, it gives you asset allocation without much of a hard work. In fact, in that portfolio tracker, you can also put your PPF, EPF, NPS investments, or fixed deposits or bonds or anything that you may have. So it actually gives an investor his overall asset allocation, and there is no other way you can do it yourself. So it's a very simple tool, and millions of people at Value Research use it for this purpose. So do this, follow these principles, and do nothing else. You'll be okay.
And be invested for a longer period of time.
Of course.
What is that horizon? What is the best? I mean, more than the number of years, better it is. But minimum at least
5 years.
5 years?
Anything less than 5 years you should not even consider equity. For less than 5 years, for a non-negotiable goal, you need to be even more conservative. But 5 years regular investing, I think in equity, you should not be disappointed.
Okay. So what Dhirendra is
your ability to beat fixed income, your ability to beat inflation, that basic goal should be achieved if you have this time frame.
Okay, with your permission then.
Sure.
5, I'm putting them under 5 heads. What Dhirendra just said: be a regular investor, do not time the market, continue with your SIPs, even in the lean times, diversify, invest in equity with a horizon of 5 years or more, and also work on asset allocation plan. Am I right?
Sure.
Okay. With that in mind, let the successful investment in 2020 begin. We move on to the Q&A part of our program now, and the first question has come from Sankaran Narayanan, and he's written that what are the investment options for retirees to generate regular income in 2020?
You need a plan, and this is going to be a very difficult phase for all the retirees, people who will be depending on their investment for generating regular income. Life was easy before. You can put your money in a fixed income, and fixed income, by fixed income I mean deposits or bonds or senior citizen savings scheme or the PPF returns. They were good enough for you to actually beat inflation. I visualize that in future they will come down. They have already come down. They're beginning to come down, and they will come down even lower further. And in retirement, your risk tolerance is low. When you can't take huge risk with your investment even if it's a volatile investment, assuming that generally it goes up, but it goes up and down more often. It's scary for people who have stopped earning money, and they only have their accumulation to bank on. So they need to deal with it carefully. The only way for such investor is to work on an asset allocation. You can't do without equity, because the reason is that if you put all your money, assuming that you have 1 crore of rupees, and somehow you are able to generate 8% on that. 8% on a 1 crore rupees, 8 lakh rupees a year. 8 lakh rupee translates into something like 65,000 rupees a month. Assuming that is pre-tax. So you will have to pay taxes on that. So if you are able to generate that kind of return, and if it is good enough, the problem will be after 5 years that your need for income will be for more than 8 lakh rupees. Your need for income 5 years from now will be 8,80,000 rupees, assuming 10% inflation in 5 years' time on your household expenses. That will not be supported by the same investment, which means that the need for your capital to rise or to grow in value is just as important as in generating income. Most of the fixed income alternatives which investors are used to, it retains the, it protects the capital. It retains the value, it keeps the capital constant, and you consume all the income generated from that, and that will create a problem for you. So you need an investment method whereby your capital will rise, will grow, and a part of your capital should grow so that it can support higher income requirement. So work on an asset allocation, maybe 20%, 30%, 40%, 50%, depending on what is your scale of income requirement.
They have to get into
equity. Otherwise your principal will lose value and it will not be able to support higher income.
Okay. Chandramouli Patel has written to us asking us the advantages and disadvantages of the index funds. Do they give superior returns other than diversified equity funds?
The advantage of an index fund is that you are assured of matching the index. Okay. You choose to be an average, which an index is. The other advantage is that they are low cost, but then finally, even after low cost. The disadvantage is that you give up the prospect of beating the index, which I think is an aspirational thing for most equity investor. Also in India, it is not a huge aspiration because on a year-on-year basis like 2018, 2019, many funds were unable to beat the index. So on an annual basis, many funds may not be able to beat the index. But when we look at 5-year time frame, 7-year time frame, 10-year time frame, regular investment, SIPs, most funds are able to beat, large number of funds are able to beat the index by a wide margin. Ability to beat the index by a wide margin, where in India, the index, our equity return itself will be higher. Even the index return will be reasonable or respectful, a decent return. Ability to beat the index by a wide margin on a 5-10 year basis, it actually makes you wealthier. So even on a, low cost and ability to, the chance of not being beaten by the index is the charm of an index fund. The other, and the disadvantage is that you will not be able to beat the index, which most fund managers are able to on a longer time frame, which should be your time frame when investing in equity.
Okay. I'm 55 years of age and I've been a mutual fund investor, writes Indraneel Haldar. Lately, there's been a lot of noise about private equity. Can you please tell me the plus and minuses of it? Also, would you suggest investing in it? Would that be safe?
Private equity is not an alternative for any individual investor. It's the institutional investors. And private equity, they are, some large investor pool their money and very large investor, and they try to buy the company. Okay. They try to buy the company they try to buy the controlling interest in a company to cause a change in the company, to cause a change in the management of the company, or take actions which will radically alter the complexion of the company. So they are large investors who get into the realm of managing the company more, in a more affirmative way, in a more involved way, and there are no avenues for individual investors to actually put their money in the private equity fund.
Okay. Pulkit Soni has written to us, should I consider return of premium term insurance policies as an option for retirement planning?
No, I would say that, think of your retirement plan as, work on a plan. Be disciplined about it. But term plan is, return of premium plan is the bait. The moment one should look at insurance, any term plan, as buying a protection, paying money to buy protection for your family, just in case, until the point you don't have your adequate net worth, financial net worth, which can support the family. And after that, once you have built that thing, once you have built your net worth which can support your family, you don't need a term plan, you don't need an insurance. So I would say that the sound principle is to look at insurance as a cost of buying protection for your family, and you should not look at it in terms of trying to get your money back. Make your investment sensibly. That's about it.
Okay. Is it safe to invest in mutual funds after retirement? And this is a question from Gurunathan Gopalakrishnan.
Oh, it's not only safe, but I think it is important, and it is you should look at it very seriously for the reason that mutual fund is actually not an asset class. Okay. Mutual fund is a way to invest in equities and fixed income in a more organized way. Because when you invest in an equity fund, you are able to instantly diversify. Somebody is responsible for managing that money. It provides you the convenience of doing that investment without going to a stockbroker, without doing a lot of learning, without doing all the hard work associated with investment. So you get your money managed with convenience, and there are some other advantages, particularly in case of fixed income fund, that they are also more tax efficient, they are also more liquid, they are making accessible something which is otherwise not available to individual investor. You can't buy those kind of government bond, but you can buy a government security fund, things like that, or the overnight fund or the liquid fund. So mutual funds you can't avoid. I think for most investors it's a sensible investment choice and an important one.
Okay.
Now in your retirement your complexion changes.
As you
choose the appropriate choose the appropriate kind, plan it methodically, learn a little bit about how to approach it. But if you are not going to invest in mutual funds post retirement, you will be in trouble if you have barely adequate money to support your income on a standard return.
Okay. Does it make sense to invest in a direct plan of an index fund with an expense ratio of 0.3% to 0.4%? Why are they so expensive? And this is a question from Prashant Balachandran.
They are expensive because mutual funds bear some expenses, or they have chosen to they think that this is the expense which will give them profit as well as there is some underlying cost. Okay. But you also have some cheaper alternative, the ETF. But you have some other kind of cost associated with the ETF. You'll incur the brokerage, and you need to really operate. Also, when you buy the index ETF, you have to worry about the premium or discount at which these ETFs will be available, because the way to buy ETF is the way you buy stocks.
Okay. Doyo Taco has written in saying, please explain how compounding works, especially in case of mutual funds.
Broadly, there are two kinds of mutual fund. One is an equity fund and the other is a debt fund. Debt fund, compounding works exactly like the compound interest, because when a fund manager is investing in a set of bonds, he is getting the interest on time from those underlying bonds, and those get added and that gets reflected in the NAV. In case of equity, the compounding works in the same manner as you buy a stock, that the price goes up and NAV goes up, and if the price is going down, it's not compounding, it is decompounding. So you are actually you are witness, or you will experience all the gains and losses. Compounding, the way it works is that whatever is the appreciation in value, and from there on whatever compounds. So when you look at the return of equity fund over a period of time, or you look at any fund return at Value Research Online for 5 year, 10 year, the annualized return which you see there is the compounded annual return. Compounding works because it's the underlying value going up in value, the underlying price of those underlying assets going up in value is what translates into compounding.
Okay. Giteshwar Kumar Gupta has written in, what should be preferred by a retail investor, mutual funds or equity shares?
Retail investors depend on the scale. There are three things which I think is important when investing. If one is the basics, what we talked about, what we keep talking about all the time, that you should have long-term money, you should have a temperament, you should be disciplined about it. But besides that, assuming that you have long-term money and you are investing for 5 years and more, and you have the choice of investing in an equity fund or a bunch of shares yourself directly, three things which I think is important is you should have the time.
Yeah.
You should have the you should have the knowledge of how to use that. You can't speculate in stocks. That is a fire way of losing a lot of your capital very quickly. So you can't speculate. So you have to be thoughtful about it. Okay. And third is the temperament. If you don't have the patience and the discipline of buying stocks at the right time, or waiting patiently with your cash and not investing, because investing in stock directly, and then the discipline of building a diversified portfolio, having a temperament to hold them for the long run. You come across a bad news about the company which you have bought, you witness a 20% decline, and you are ready to run away. So if you don't have that temperament, you will not win with your equity shares directly. So if you have these 2-3 things, time, understanding, and a temperament, don't even think of investing in stocks directly.
Okay. Dhiren, thank you so much for answering and throwing light on how the investment resolution for 2020 be done. Please make sure what Dhiren has told you so that you have a successful 2020 and beyond with you if you invest with the resolutions as elucidated by him. Till we meet next time, it's goodbye from me and Dhiren Kumar.